Okay, so when you're shopping for a life insurance, what's the very first number you look at? Come on, be honest. For pretty much everyone, it's that monthly premium, right? But what if I told you that number, that one little number, could be totally misleading you? Today, we're going to pull back the curtain and find out the true cost of a life insurance policy.
It just seems so logical, doesn't it? Find the policy with the absolute lowest monthly payment, and boom, you've got the best deal. But is the policy that costs the least out of your pocket today really the cheapest one over its entire lifetime?
Well, the short answer is a big, resounding no. And really understanding why that is, that's your first step toward making a much, much smarter decision for your financial future.
So let's dive right in by talking about what I call the low premium trap. It's such an easy assumption to make, but man, it can really lead you down the wrong path if you're not careful.
Here's the absolute key insight you need to get. The premium is only one side of the equation. It's the money going out. To find the real cost, the true cost, you have to factor in the value you might actually get back from the policy over the years.
So, how in the world do we figure that out? Well, it all starts by kind of redefining what we even mean by the word cost.
Think of it like this, a super simple formula. The true cost is just what you pay in premiums minus whatever value you get back from the policy. And that value can show up in different ways, like a growing cash reserve you can tap into, or even dividends, which are like profit-sharing payments from the insurance company.
So let's break down that value piece. First, you've got the cash value. That's a savings component that actually grows over time. Then there are potential dividends, which you might get if the insurer does well financially. And of course, the whole reason for the policy in the first place, the death benefit that goes to your loved ones. Each one of these plays a role in the policy's actual true cost.
Now you might be thinking, okay, this sounds complicated to figure out on my own. And you know what? You'd be right. But luckily, regulators have created some official tools to help us compare policies fairly. Think of it like a standardized nutrition label, but for insurance.
Yeah, the National Association of Insurance Commissioners, the NAIC for short, they actually require insurers to give you two specific scores. They're called interest-adjusted cost indices. And because every single company has to use the exact same formula, it lets you make a real apples-to-apples comparison. So, these two indexes are designed for two totally different goals. Both of them factor in the time value of money, so you get a score in today's dollars. The surrender cost index, that's your go-to if your main goal is building up cash value that you might want to access later on. The net payment cost index, on the other hand, is what you look at if your one and only goal is to leave behind the biggest possible death benefit.
Okay, so beyond these official scores, there's another really powerful do-it-yourself comparison you can run, especially if you're trying to decide between different types of insurance. It's got a formal name, the Comparative Interest Rate Method, or CIR, but you've probably heard its more famous nickname, the buy term and invest the rest strategy.
The whole thing is really just a simple thought experiment. First, you compare the premium on a more expensive permanent policy to a much cheaper term policy. Then, you imagine taking the difference in price and investing it yourself every year. The final step is to ask the big question: what rate of return would my own investment need to earn to end up with the same amount of cash value that's building up inside that permanent policy?
Let's look at a quick example to make this real. Imagine a 30-year-old who wants $150,000 of coverage. A whole life policy might run them about $2,000 a year, but a term policy for the same amount, only $500. This whole strategy just asks, okay, what if you took that $1,500 difference and invested it every single year?
Now this next part might seem a little backwards, but stick with me. Here's the big takeaway. If you do the math and find out you'd need to earn some crazy high rate of return, like say 10% a year on your own investments, just to keep pace with the permanent policy, well, that's actually a sign that the permanent policy is the better value. It means it's doing the heavy lifting for you.
Okay, we have definitely covered a lot of ground. We've got the official indexes, and we've got this do-it-yourself, invest the rest test. So how do you know which one to use and when?
So let's wrap this up. Which tool is for you? The official surrender cost index is best when you're comparing policies and cash value is your top priority. The net payment cost index is what you use when the death benefit is all that matters. And that comparative interest rate method, that's your go-to when you're trying to decide between term and permanent insurance in the first place. See, the right tool just depends on what your financial goal is.
So, look, if you take just one thing away from this whole explainer, please let it be this. Do not get caught in the low premium trap. The premium is just the sticker price. Your job is to use these tools to look under the hood and find the true long-term cost and the real value of any policy.
Because ultimately, this isn't just about spreadsheets and numbers, it's about what you actually want to achieve. Do you want cash you can use later, a guaranteed death benefit for life, or something else completely? Now that you have the tools to really compare, the real question is, what does value truly mean for you and for your future?